you look at this, we're saving just $3,600 a year, and you can see that by year 20, this is just a guaranteed savings account, and it's getting better and better and better and more powerful. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about what you should do with the money that you have just sitting in your savings account, losing money to inflation, and ultimately what you can do instead of that. So I'm super excited about this. Here's the bottom line. Most of the time, let's face it, we all need to keep money in a savings account. We need to have money that we have liquidity, use, and control of. Maybe you're saving that money because you're waiting for an opportunity. Maybe you're saving it because you're just a responsible human being and you want to make sure you have money put aside in case of an emergency, that proverbial rainy day fund, as everybody likes to talk about. And maybe you're looking to save 6 months of income in there. Maybe you're looking to save, in my opinion, I think you should have about a year to 2 years of income in a safe account. And I'm not going to get into all the whys and all that stuff about this. If you haven't checked this channel out before, I would really encourage you to hit the subscribe button, click the bell, that way you get notified, because I do a video every single day on these topics. I talk about all of this stuff about personal finances and financial efficiency all the time, and I know that you'd be served by following. Now, also want to invite you, to finish my shameless plug here, I want to invite you to check out my book. Actually, here it is. Sorry, I had it under something. Cash Flow Hacking is how to reach financial freedom in about a decade by investing for cash flow, by getting out of the stock market, by stopping following the traditional methodology of buy and hold and waiting 40 years to hit your goals. Because let's face it, that strategy isn't serving North Americans, no matter how we look at it. And so what I want to do in this video is I actually did an illustration, and I want to show you, I'm going to go on my computer here. I'm going to share my desktop, and I'm going to show you exactly, if you have, let's call it $25,000, and this could be 25,000, it could be 50,000, it could be 100,000. It doesn't really matter the amount. I really thought 25,000 was kind of like the good benchmark of what you could do if you had capital, if you had this kind of money, and your mindset was you were saving for opportunity. Maybe you're saving for a real estate fund. Maybe you're saving because you're worried that the sky is going to fall and we're going to go off this financial cliff. Or maybe it's literally just there for your emergency fund. And what I want to do now is I want to show you what you should do with that money if it's just sitting there losing money to inflation. So let's go. All right, so here you can see, I know this may surprise a lot of people. If you subscribe to this channel, it probably doesn't surprise you at all, but this is a properly designed whole life insurance policy utilizing a front-loaded single paid-up additions rider that allows you to put a lot of money into the policy up front and reduce your annual commitment. And it basically takes all the money that you were saving on an annual basis, and it helps create what we would call a forced savings plan that gives you basically a savings account on steroids. And I'm going to show you how this works and talk to you about all the benefits in this. And ultimately, I think by the time you're done watching this video, you're going to be convinced that, because it's just logic and it's just math and it's just, in my opinion, common sense, that by the time I get through the end of this, you're going to see that it only makes sense if you have any kind of money sitting in a savings account. You're going to want to move it and put it into one of these. And by the way, if you get to the end and you decide that that's the case, you can go ahead in the description below, click on the link. You'll see there's access to a free clarity call. The Calendly link is down below, or you can go to life180.com and you could set up a free consultation, free clarity call with one of our Life 180 financial coaches, and they will help you figure out what the best potential strategy could be for you and to see if it makes sense for you at all. But now getting into this, here's the deal. You got $25,000. So what I did is, you can't just move the $25,000 over. I want to make this really abundantly clear. You cannot just move the $25,000 and then not have a premium payment. This only works if you're able to pay the $25,000 into the policy and you're able to continue saving a minimum monthly or annual payment into the policy. So in this example, what I did is I said, this individual, and you could see I did 20,000 YouTube. So I was just using this example of 25,000. That's the name of the person. I just had to put it in there. So in this example, we have $25,000 as the front load going into this policy, like just a dump in of money. And then we have a $300 per month premium going in. So that winds up being $3,600 per year. And so that's why 25,000 plus 3,600 is 28,600. And so here's the deal. You can see this year one, you put 28,600 into the policy. Now, year one, you lose some liquidity of that money. You only have $26,304 of cash value available. Now, there's a lot of things that go into this. Think about this. You lose a little liquidity, but when we compare the short-term pain, so to speak, to the long-term gain, I think you're going to realize that this is going to get you to where you want to go far faster, far more predictably, and with a lot more benefits. That's why I call it a savings account on steroids. Now think about this. The cost of this, yes, there's a little pain, but because you're losing about $2,000 in liquidity. But check this out. You pick up $469,000 of death benefit. That's pretty awesome. I don't know about you, but that $2,000 year one right out of the gate is, even though you lose liquidity of it, you pick up that death benefit. That's worth it on its own, especially when you consider that you have living benefits associated with that $469,000. So if you become critically, chronically, or terminally ill, you can access a portion of that death benefit while you're alive. Like that right there on its own, from a financial planning and protection perspective, is worth its weight in gold for you and your personal finances. Now, moving on to year two here, you can see you put in $3,600, and the net increase in cash value, meaning between the dividend and this year's premiums, your cash value went up $3,574. So you literally almost broke even. You basically lost $24, and you can see here your death benefit actually went up to $475,000. So that's pretty powerful stuff. And where it gets really amazing is year three, where you put in $3,600 and it grew by $3,766. So the first 2 years are what we call the capitalization phase, and year three is what we would call the offset year, right? Where the premium is less than the policy is growing by. And so when you hit that year, and the goal is to make that offset year as soon as possible in the policy, from a liquidity perspective, from a leverage perspective, it's not always in year three. Sometimes it's year 6 or 7 or 8, and that's not necessarily a bad thing either. These things, they're always a give and a take, and it always depends on how they're designed and what the purpose is and what your objectives are. Once again, there's no free lunches with anything in the financial industry. That's why it's important to work with somebody that understands all the moving parts and the nuances behind these policies. However, when you look at this, you can see by year 10, we've put in 36,000 plus 25,000 is, let's just call it 61,000, right? But we have $66,000 in net cash value. And you can see that the dividend on top of the guarantees are being paid $2,364, and the death benefit has grown from $469 to $532. Now, this is the other thing. If you were to just keep your money in the savings account, you'd have, let's say in that scenario, you'd be earning 0.1%. You would have put 61,000 in. You'd probably have $61,100 in there, maybe $161,150 or something like that. I haven't done the math on it, but it's not good. I promise that. So you're going to have a better rate of return here. Now you also have the death benefit. So if you were to save your money in a savings account, and you were to, because once again, I don't want to compare this to an investment. I'm not going to say if you were to buy term and invest the difference, because if you were to buy term and invest the difference and follow that strategy and listen to Dave Ramsey, you're still going to have money in an emergency fund outside of the buy term, invest the difference strategy. So what I'm talking about here is just comparing where you're saving your emergency fund. And if you do that, well, this is the best place. You're not going to find a place that's better than this from a liquidity perspective, from a growth perspective, and from an ancillary benefits perspective, because this gets you a death benefit on top of it. And you can see when Dave always says you don't get to keep the cash value and the death benefit. So let's just say you decided to save money in a savings account and you bought a $469,000 death benefit right out of year one. Right now, by the year 10, you're going to have the $469,000 death benefit and $60,000. But what happens if your death benefit expires, because most people don't have their term policy when they die. Less than 2% of term policies are ever paid out on, so that's important to understand. So when you look at this, it's important to get when Dave says you don't keep the cash value and the death benefit. Well, look at this. The cash value has grown, so too has the death benefit by more than the cash value has increased. So what's happening here? What's happening is that the death benefit is going up because the cash value is going up. And while they don't pay you the cash value, what they do is they lump the cash value into the death benefit. That's why it's growing. It's called paid up additions. And by doing that, they're able to pay you the death benefit completely tax-free. If they were to separate the two and pay you the cash value, that would have to be taxed the same way a savings account is taxed. And so think about that. You don't want that. So it's so funny to me that people buy into this thing with Dave about, oh, you don't get to keep the cash and the death benefit. Well, guess what? It's done that way strategically because it's to your advantage. And so to me, that's really just kind of disturbing and funny all at the same time. But here's where it gets really, really powerful. Like if you look at this, we're saving just $3,600 a year. And you can see that by year 20, this is just a guaranteed savings account, and it's getting better and better and better and more powerful. By what are we saving? 36, 72 plus 61. I'm trying to think about 36, 72, 108 plus 25 is 133. So you put 133,000 in over 30 years. And you got $239,000 of cash value, plus you have a $728,000 death benefit. Now, that's why I always tell people this is a hedge against inflation. Now, if you go back in history, these numbers that I'm showing you today, right now on this sheet, I'm really confident that it's actually going to outperform what this does because these are based on current rates and current dividend scales, which are the lowest that they've been in about 80 years, right? And so when you look at the fact that dividend rates have never been this low in the past 80 years, and the fact that I believe because of inflation and because of the way this market is going, that rates have nowhere to go but up. And if the interest rate environment goes up, this policy is actually going to perform better. And so in my opinion, and this isn't a guarantee, I'm not telling you, I'm not trying to overhype this, but in my opinion, because of the rates and the environment that we're in, it's really likely that this will actually outperform the illustration. So you just got to understand all the nuances and all the moving parts behind all this stuff. So at the end of the day, here's the deal. Like I said, this becomes a no-brainer. If you could take your money out of the bank account, you could get a hedge against inflation, you could pick up life insurance, you could pick up living benefits if you become critically, chronically, or terminally ill, you get to access some of your death benefit while you're alive to manage your health directive the way that you want. And if you get all of this, and you're going to get better performance without losing liquidity, use, and control of your money in the process. To me, the only downside is you lose maybe a very small fraction of your liquidity on the front end during the first 2 years. That's a little bit of a capitalization phase that you have to do this. But like I said, there's no free lunches. You got to pay that to take advantage of the system and get everything in place. And when you understand that, this really becomes a no-brainer. So at the end of the day, I hope that makes sense. And if you have any questions, just go ahead in the comment section below, leave a comment. I respond to every single comment I see. If you are interested in talking to a financial efficiency coach, we have Life 180 coaches that can help you take this, figure out how to implement it in your life. We call it a clarity call because there's literally no obligation. My passion is helping people understand this, because I believe if everybody just understood what I know about this, if everybody got that, every single person on the face of this earth would be doing this, and the way that everybody operated with their money would be completely different, and that would completely change the dynamics of money in North America, in America and Canada. And you know what? That's kind of what fires me up. That's why I do these videos. So hopefully you found value in this. If you did, please smash that like button if you haven't already, and hit the subscription button, hit the bell. That way you get notified every time I launch a new video, because guess what? I'm trying to drop videos every single day. I'm actually starting to create more short content now as well, both on the Life 180 YouTube channel here, but I'm also going over and I'm dropping those videos on TikTok. I'm putting them out on Instagram, and I'm putting the videos on my Facebook page as well. So whatever channel you watch either Reels or Shorts on, make sure you go hit me up at Real Chris Kirkpatrick on those platforms, and I look forward to seeing you there. Make sure if you do go there and you see me, make sure you hit me up and let me know that you're coming from YouTube, and I'll give you a pound. So anyway, that's it for now. Have a blessed, inspirational day. I'll see you on the next video. Take care.